Hello friends. Today we are again here with the new session of School of Pipsology, which is Undergraduate, Sophomore. In this session we have 4 courses. First is the US Dollar Index. Second is Intermarket Correlations. Third is Using Equities to Trade FX. And fourth is Country Profiles. So in this video we will discuss about first course, which is the US Dollar Index. In this course we have below lessons. What is the US Dollar Index, USDX? How to read the US Dollar Index. Trade-weighted dollar index. How to use the USDX for forex trading. The dollar smile theory. So let's start with first lesson. What is the US Dollar Index, USDX? If you've traded stocks, you're probably familiar with all the indices available such as the Dow Jones Industrial Average, Dow Jones Industrial Average, Nasdaq Composite Index, Russell 2000, S&P 500, Wilshire 5000, and the Nimbus 2001. Oh wait, that last one is actually Harry Potter's broomstick. Well, if US stocks have an index, the US dollar can't be outdone. For currency traders, we have the US Dollar Index, USDX. The US Dollar Index consists of a geometric weighted average of a basket of foreign currencies against the dollar. Say what? Okay, before you fall asleep after that super geeky definition, let's break it down. It's very similar to how the stock indices work in that it provides a general indication of the value of a basket of securities. Of course, the securities we're talking about here are other major world currencies. The US Dollar Index Currency Basket. The US Dollar Index consists of 6 foreign currencies. They are the Euro, Yen, Pound, Canadian Dollar, Krona, Franc. Here's a trick question. If the index is made up of 6 currencies, how many countries are included? If you answered 6, you're wrong. If you answered 24, you're a genius. There are 24 countries total, because there are 19 members of the European Union that have adopted the euro as their sole currency, plus the other 5 countries, Japan, Great Britain, Canada, Sweden, and Switzerland, and their accompanying currencies. It's obvious that 24 countries make up a small portion of the world, but many other currencies follow the US dollar index very closely. This makes the USDX a pretty good tool for measuring the US dollar's global strength. USDX can be traded as a futures contract, DX, on the Intercontinental Exchange, ICE. It is also available in exchange-traded funds, ETFs, contracts for difference, CFDs, and options. US Dollar Index, USDX, components. Now that we know what the basket of currencies is composed of, let's get back to that geometric weighted average part. Because not every country is the same size, it's only fair that each is given appropriate weights when calculating the US dollar index. Check out the current weights. With its 19 countries, euros make up a big chunk of the US dollar index. The next highest is the Japanese yen, which would make sense since Japan has one of the biggest economies in the world. The other 4 make up less than 30% of the USDX. Here's a question. When the euro falls, which way does the US dollar index move? The euro makes up such a huge portion of the US dollar index, we might as well call this index the anti-euro index. Because the USDX is so heavily influenced by the euro, people have looked for a more balanced dollar index. More on that later though. First, let's go to the charts. Let's come to the next lesson, which is how to read the US dollar index. Just like any currency pair, the US dollar index, USDX, even has its own chart. Holler at the US dollar index. First, notice that the index is calculated 24 hours a day, 5 days a week. Also, the US dollar index, USDX, measures the dollar's general value relative to a base of 100.000. Huh? Okay. For example, the current reading says 86.212. This means that the dollar has fallen 13.79% since the start of the index, 86.212 to 100.000. If the reading was 120.650, it means the dollar's value has risen 20.65% since the start of the index, 120.650 to 100.00. The start of the US dollar index is March 1973. This is when the world's biggest nations met in Washington, D.C., and all agreed to allow their currencies to float freely against each. The start of the index is also known as the base period. The US dollar index formula. This is strictly for the grown and geeky. Here is the formula for calculating USDX. Got that? Good. Now you can get a wedgie from the school bully. We're kidding. Let's discuss. Another topic: trade-weighted dollar index. There is also another kind of dollar index used by the Federal Reserve. It is called the trade-weighted US dollar index. The Fed wanted to create an index that could more accurately reflect the dollar's value against foreign currencies based on how competitive US goods are compared to goods from other countries. It was formed in 1998 in order to keep up to date with US trade. The trade-weighted US dollar index. From strongest to weakest, here's the current weighting, in percentage, of the index. Weights as of February 12, 2017. The main difference between the USDX and the trade-weighted US dollar index is the basket of currencies used and their relative weights. The trade-weighted index includes countries from all over the world, including some developing countries. Given how global trade is developing, this index is probably a better reflection of the dollar's value across the globe. The weights are based on annual trade data. Weights for the broad index can be found at below address. If you'd like to see historical data, check out with below link. Let me tell you how to use the USDX for Forex trading. I bet you're wondering, how do I use this USDX in my trading arsenal? Well, hold your trigger finger and you'll soon find out. We all know that most of the widely traded currency pairs include the US dollar. If you don't know, some that include the US dollar are euro to US dollar, pound sterling to US dollar to Swiss franc, US dollar to Japanese yen, and US dollar to Canadian dollar. What does this mean? If you trade any of these pairs, the USDX can be the next best thing to sliced bread, or hamburger on a bun, or chocolate ice cream. If you don't, the USDX will still give you an idea of the relative strength of the US dollar around the world. In fact, when the market outlook for the US dollar is unclear, more oftentimes than not, the USDX provides a better picture. In the wide world of Forex, the USDX can be used as an indicator of the US dollar's strength. Because the USDX is comprised of more than 50% by the Eurozone, euro to US dollar is quite inversely related. Check it. USDX daily chart. Next, take a look at a chart of euro to US dollar. Euro to US dollar daily chart. It's like a mirror image. If one goes up, the other most likely goes down. Will you look at that? It seems like the trend lines almost inversely match up perfectly. This could be a big help to those big on trading euro to US dollar. Some of our Forex trading friends in the forums monitor the USDX as an indicator for euro to US dollar. Hang out with them if you want to learn more about using this index. If the USDX makes significant movements, you can almost surely expect currency traders to react to the movement accordingly. Both the USDX and Forex traders react to each other. Breakouts in spot USD pairs will almost certainly move the USDX in a similar breakout fashion. To sum it all up, Forex traders use the USDX as a key indicator for the direction of the USD. Always keep in mind the position of the USD in the pair you are trading. For example, if the USDX is strengthening and rising, and you are trading euro to US dollar, a strong USD will show a downtrend on the euro to US dollar chart. If you are trading a pair in which the USD is the base currency, such as the US dollar to Swiss franc, a rise in the USDX will most likely show a rising US dollar to Swiss franc charts like the one shown below. Here are 2 little tips you should always remember. If USD is the base currency, then the USDX and the currency pair should move the same direction. If USD is the quote currency, then the USDX and the currency pair should move in opposite directions. Let's come to the last lesson. The dollar smile theory. Ever wonder why the dollar strengthens both in times of tough luck and when the economy is booming like a Beyoncé single? Well, so does everybody else. In fact, this really smart dude over at Morgan Stanley came up with a theory to explain this phenomenon. Stephen Chen, a former currency strategist and economist, came up with a theory and named it the dollar smile theory. The dollar smile theory explained. His theory depicts 3 main scenarios directing the behavior of the US dollar. Here's a simple illustration. Scenario number 1, USD strengthens due to risk aversion. The first part of the smile shows the US dollar benefiting from risk aversion, which causes investors to flee to safe haven currencies like the dollar and the yen. Since investors think that the global economic situation is shaky, they are hesitant to pursue risky assets and would rather buy up the less risky US dollar regardless of the condition of the US economy. Scenario number 2, USD weakens to new low due to weak economy. Dollar drops to a new low. The bottom part of the smile reflects the lackluster performance of the greenback as the US economy grapples with weak fundamentals. The possibility of interest rate cuts also weighs the US dollar down. This leads to the market shying away from the dollar. The motto for USD becomes sell, sell, sell. Scenario number 3, USD strengthens due to economic growth. The dollar appreciates due to economic growth. Lastly, a smile begins to form as the US economy sees the light at the end of the tunnel. As optimism picks up and signs of economic recovery appear, sentiment towards the dollar begins to pick up. In other words, the greenback begins to appreciate as the US economy enjoys stronger GDP growth and expectations of interest rate hikes increase. This theory appears to have been in play when the 2007 financial crisis began. Remember when the dollar got a huge boost at the peak of the global recession? That's phase 1. When the market eventually bottomed out in March 2009, investors suddenly switched back to the higher-yielding currencies, making the dollar the winner of the worst currency award for 2009. That's phase 2. So will the dollar smile theory hold true? Only time will tell. In any case, this is an important theory to keep in mind. Remember, all economies are cyclical. The key part is determining which part of the cycle the economy is in. So friends, this course is completed here. In upcoming video we will discuss about next course of this session, which is intermarket correlations. So stay tuned.